Good afternoon. Welcome to Midcap Radar, live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Good afternoon, Vivek. Well, it's a Monday where we are seeing cuts come through continuously. Friday, we went below that 25,200 mark. We are very close to the 25,000 mark right now. Across the board, it's a red, barring the Midcap index.
That's right, and aptly named, it's Midcap Radar, so that particular index continues to hold out in the green. But we have a lot lined up on the show, an important management conversation as well. So let's start off with the top headlines. US President Donald Trump spooked the street by announcing a 30% tariff on EU and Mexico over the weekend. IT and financials drag, while realty, pharma and healthcare eke out gains. Midcaps buck the trend.
After multiple SPE and Sacheti brothers signed to pick a 32% stake in VIP Industries, followed by an open offer, promoter Dilip Piramal tells CNBC TV18 an ownership change was needed to put the business on track and that he'll trim his residual holding from 20% to 8% in 5 years.
Ola Electric surges as earnings improve sequentially. The loss-making company also gives a very strong guidance for FY26, and that boosts sentiment.
AUSFB under pressure after Kotak Institutional Equities downgrades stock to sell and raises target to 700 rupees a share. They say that if macro environment turns favorable, bank can deliver healthy business growth ahead of peer banks.
NCC gains after winning a near 2,300 crore rupees MMRDA contract. The company bags an order for rolling stock telecommunication systems of Mumbai Metro Line 6.
Okay, those are the top headlines for the markets. We've been pointing out it's very close to that 25,000 mark. We'll have to see whether that important level is broken today or not. Still have 2 hours to trade. The mid-cap's doing well, 0.5% higher on that index. And there are pockets which are doing really well. The pharma space, for instance, has been consistently outperforming today. Be it something like Newland Labs, which is up 12%. You have Alembic Pharma, which is up 5%. Loris Labs, Granules, Walkhard, you name it. And that pharma stock is surging. And how? Of course, we'll get more details in a bit from Hormuz as well, but we did speak to Walkhard today. We did see a lot of news updates come by in the entire pharma space. So it's about deals, it's about results, it's about news flow, a very, very heavy and busy day.
And tariffs on top of that as well. That's right. If you could just pull up the stock of IFCI, you saw some important flashes on your screen. The company is looking at consolidating its business segments, and there's going to be a merger of all of the holding finance companies within itself. And on the back of that, that stock is up almost 7%. But Hormaz has been waiting patiently by the wall. This is our special segment, Midcap Movers. It's going to take us through all of the midcaps that are moving around in the session.
Well, if there is someone who needs patience right now, it's the bulls, considering the fall that we are seeing in the markets. But of course, the broader markets are doing fairly well for themselves, and that could provide some bit of comfort if you shift your focus away from the benchmark screens. But we'll start off with some of the gainers then in the broader markets, considering they are the outperformers today. Look at Newland Laboratories, 12% higher on that stock. Every single pharma name, as Sonal was highlighting, doing well in today's session. Anand Rathi Wealth, after its earnings gains on Friday, is building on those, 9% higher here as well. Piramal Enterprises, although Piramal Group stocks doing well today, and Godfrey Phillips too at the highest point of the day, 6.5% higher on that stock as well. And some of the newsmakers in today's session, of course, Ola Electric has been hogging the limelight over the last couple of hours, 15% higher on very strong volumes. Walkhard, of course, after exiting the US generics business, BSE with all the developments with regards to Jane Street, and Lakshmi Dental finds a mention here because of a very strong initiation note from Motilal Oswal. Pharma stocks, as I just mentioned, we just highlighted a couple of them, but look at the others. Loris Labs is at a record high. Mankind Pharma is building on those gains. Torrent Pharma at the highest point of the day. Granules too trading with gains of around 4%. So it's a very, very healthy day for a lot of these pharma companies. Stocks on the volumes front, India Mart is up 5%. VPRPL, well, has given up most of those gains, still holding on to a 4% advance, but on very strong volumes. Sai Life Sciences and Graphite too seeing a good move in today's session, and stocks that are at a 52-week high in today's session. Take a look at Control Print, up 8% today. Thyrocare is at the highest point of the day, a very sharp spike in the last few minutes. Suven Life and Cartrade Technologies, the most underperforming IPO until last year, is now an outperformer, 3.5% higher at a 52-week high. Back to you guys.
Okay, all right. Interesting names. Control Print, there is Cartrade Tech, some names that should be on your radar. Thank you, Hormuz, for joining in as always, it's a good time to get a technical check on the markets. Ruchit Jain from Motilal Oswal is joining us just for that. Ruchit, good afternoon. Thank you for joining in. There's a wee bit recovery on the Nifty, but that's what we've been seeing, the recovery getting sold into. Do you think that is a trend that could continue? What is the important level on the Nifty right now?
Yeah, hi, very good afternoon. Well, in last 1.5 weeks, we have seen some correction from the highs in the index as well as the broader markets. Generally, when the corrections are there within an uptrend, we either see some time-wise correction or a price-wise correction phase. And 40-day exponential moving average usually acts as a good support in case if it's just a time-wise correction phase. Now, I think post this correction, we are trading right now near that average, which is in around 25,000 to 24,900. And along with that average, there is also a rising trendline support of the recent up move that we have seen. So we are seeing that 25,000 to 24,900 is a very crucial support zone. And if this remains intact, then probably market should resume the up move after some 2 or 3 days of consolidation around these levels only. But only if 24,900 is breached, then we will expect some more price-wise corrective phase. Otherwise, I think the risk-reward ratio is favorable to take some contra call over here on the index and keep a stop loss below 24,900 for an up move again towards 25,300 to 350.
Ruchit, any individual stocks for the day? Any buy or sell calls?
Yeah, a couple of names we are looking at. One is the pharma space. The Nifty Pharma Index has been one of the underperformers if you look at last 3 months of markets up move. But today the Nifty Pharma Index is showing a breakout from this entire consolidation phase. So we believe that the risk reward ratio is favorable because this is one sector which has not yet shown any up move over last few months, and now it's giving a breakout. So within this basket, Biocon is one stock which technically is looking good. A gradual high top, high bottom structure has recently been formed. Price volume action is positive. So at current levels, short-term traders can go long on Biocon with stop loss below 367 or potential target somewhere around 400 to 405. And UltraTech Cement is another stock which we are quite positive on. It has recently given a breakout of after about 1 year of consolidation phase. So 12,200, 12,100 was acting as a resistance since last 1 year, which has been broken. And even in this falling market, now the stock prices are not correcting below that level. So clear signs that we should see a resumption of the positive trend from here on. So we can be keeping stock below 12,100. One can go long on UltraTech Cement as well for potential short-term targets around 13,200.
Okay, all right. Thank you so much, Ruchit, for joining in. So those are some technical picks coming in. With that, we'll slip into a break. But remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned in to Midcap Radar on CNBC TV 18. The hotel sector is in focus. Q1 did see some disruptions, but what's the outlook going forward? Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels, is joining us for a conversation. Mr. Keswani, good afternoon. Thank you so much for joining in. Before I speak to you about what happened in Q1 or what the outlook is going forward, can you talk to us about what's happening with the company? The stock has been buzzing lately. In the past, you've spoken of an alternate structure as well in terms of asset structure. Is something brewing? Are you looking at an alternate asset structure? Any change in corporate structures? Demerging any of your assets?
Good afternoon. Well, that is certainly one of the options we are looking at. What I think I have said in the past is that we are going to basically have, we already have an asset company in a joint venture with a Dutch pension fund. and our intent is to list it. Now, the way we list it is actually what is under discussion. Will it be an IPO, and in which form? That is something I cannot comment on right now, but it is under discussion, and we're very clear we want to do it as quickly as possible.
So is there a timeline to that? Do you think it'll happen in this calendar year or maybe this financial year?
No, I said it would be by the end of next year. So we are still sticking to that. It could happen earlier, but broadly in the next 18 to 21 months, this company should list, and I think it'll have a very successful listing.
Mr. Keswani.
Yeah, please.
Yeah. So I understand, you're talking about Fleur Hotels, where you've mentioned the possibility of an IPO. You expect to complete that particular transaction by the end of FY27. What's in it as far as the shareholders of Lemon Tree are concerned? What is the holding of Lemon Tree in that particular company? And what will be I believe, that particular transaction will be to reduce debt. So what will be the debt pre and post that particular IPO?
See, our debt is not so high now. It is... our debt to EBITDA is less than 2.5. And by next year, anyway, it will be less than 1.5, closer to 1. So the intent is not only to reduce debt, which will happen automatically. The intent is also to split the company into an asset-heavy side, which attracts a certain type of investor, and a high-growth management/brand/technology side, which is where Lemon Tree is. Why are we doing this? Is basically because return on capital obviously is enormously higher in the asset-light side of the business, but it needs large scale in order to be chunky. So we want to focus on ownership/development of assets in Fleur, and management and, as I said, brand in Lemon Tree. How will it benefit Lemon Tree shareholders? Well, depends on the structure of how we list Fleur. But as I have said before, we are certainly looking at a way to significantly reward shareholders of Lemon Tree in this, because we currently own about 60% of this joint venture, and we intend to become deconsolidated, which is our shareholding should drop below 50% in this company. And obviously, how we reward shareholders is also part of this entire discussion.
Got that point. So this is something which is developing. So once there is more finality or more agreements to whatever you're looking at doing with this asset structure, we'll have another conversation. Mr. Keswani, about the business right now, there is a note from Lara today. They spoke about some one-offs that Q1 saw because of a lot of geopolitical risks. Did Lemon Tree see disruptions because of that? What was the occupancy like? And also, because of disruptions, did we see any change in pricing?
As I've said, I'm pretty happy with how we performed in Q1. I don't want to comment more than that. It is very much in line with what we expected. Yes, there was a disruption because of the near war or war. There was a disruption because of COVID. There was a lot of news articles that COVID was coming back. So there have been multiple small disruptors. But overall, as I said, we've done as well as I was hoping we would do in Q1. There is, I think, going forward, we are waiting for really H2, which is when we significantly reprice. I read in your thing that Amritsar saw a contraction in hotel rates. Well, a lot of cities saw a contraction in rates because of that temporary disruption. But I think things are coming back to normal, and Q2 should be as we expect, and H2 will be very, very good. That I think I can already sense.
Okay, so recovery in Q2 and H2 is expected to be strong. That's what we take away. The other important question is, going forward, how do you split growth? Number one, between the RevPAR, the management fees, as well as new openings, because that is something that the street wants to know.
See, we are growing very, very rapidly. So if you look at Q1, we signed 1,350 rooms, 15 hotels, most importantly in 6 new cities. We opened about 400 rooms with 5 hotels, and one of that was in a new city. In July alone, we will sign another 10 hotels, and in 8 new cities, 800 rooms. So the way I see it is, see, growth is in the asset-light business is uh, is not chunky in EBITDA, because basically every time you manage, say, 7 rooms, you really get, or 6 rooms, you really get the EBITDA of only 1 room. That is your share of the fees. So obviously, for it to be significant, you have to add a very large number of rooms when you compare it to an asset-heavy side of the business. For example, we will sign 800 rooms in July. That would be like, when these hotels operationalize, that would be like opening a 120-room hotel, because that is our share of the EBITDA. What's our perspective? See, broadly, if you look at India's personal consumption expenditure, which is about 62% of GDP, about 40% is staples and 22% is discretionary. And most of that discretionary consumption occurs in the top 200 cities of India, which have a population of 5 lakhs or more. So we are very clear we want to be in all these 200 cities. What we track most closely are which are the cities which are growing very fast, have better connectivity based on airports, airlines, roads, and Vande Bharat. And we want a presence there because it has an impact onto our entire network. And that's what we really track.
Okay. We take that point, such insightful comments coming in from you and more understanding of the industry as well. We have completely run out of time, Mr. Keswani, but we'll have a conversation again after your Q1 numbers. You did speak about a blip in Q1, but Q2 will be strong. And you spoke about addition of keys and hotels as well. That's the word coming in from Lemon Tree Hotels. For now, we'll slip into a break. More on the markets on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, a very important development over the weekend. The government has gone ahead and eased FGD norms for power plants. What does it mean for the power sector, industrial companies and capital goods? Vamakshi joins in with more details.
Well, Vivek, important point coming in out there. What has actually happened is that the Union Ministry of Environment, Forest and Climate Change has issued a notification on July 12th. Now, largely what this notification says is that thermal power plants outside a 10-kilometer radius of cities with a population of 1 million plus would be exempted from installing FGD systems, which is the flue gas desulfurization system. Now, keep in mind that such plants which have been exempted account for almost 79% of the overall operational power plants in the country. So it's a huge number. But what about the remaining 11%? Well, the notification mandates that for plants that are within the 10-kilometer radius, the mandate will be looked at on a case-to-case basis. As far as plants in cities like NCR are concerned, cities with at least 1 million population, they need to comply with the mandate, and they will be required to install FGDs by December 2027. So this overall development has negative implications for some of the industrial players like BHEL, Thermax, L&T through its arm L&T Power, HCLTech Heavy Engineering, Techno Electric, GE Power, Power Mech. Of course, the impact on all of these various companies will vary depending on how involved they are. But it's a negative impact because number one, it leads to shrinkage in the addressable market, and number two, it raises questions on the execution of the current order backlog. Now, Thermax in the Q4 con call had also highlighted that they did have an FGD order book worth almost 467 crores of which nearly 350 crores was expected to be liquidated in FY26. They have been highlighting the problems that the industry had been facing, and they have said that the FGD space has become messy, projects are not happening, and they had also said that FGD has been a bloodbath for everyone. As far as Techno Electric is concerned, their order backlog for FGDs stood at 1,450 crores, and they had highlighted in their earlier con call that they were targeting almost 500 crores of revenues from this particular segment as compared to the whole year guidance of almost 3,500 crores. This is overall for the company. So this is definitely a negative for some of these industrial stocks.
Oh yes, they had been talking about how big an opportunity this could be for these companies. Thank you so much, Mamakshi, for putting into perspective what this means and which companies would be impacted as well. But on that note, we'll do one thing. We'll take your leave on Midcap Radar. When we come back, your stocks will be here with your queries.